Every trader begins their journey with excitement, ambition, and a strong desire to win. But as the markets reveal their unpredictable nature, the same trader often finds themselves lost, drowning in impulses, switching strategies, chasing setups, and reacting emotionally to every rise and fall of price. The real breakthrough comes not from discovering a new strategy, not from forcing results, but from building a personal trading system that you commit to, and then cultivating the discipline to follow that system with consistency. Your system becomes your structure, your foundation, and your anchor in a world defined by uncertainty. A trading system is more than rules. It is a complete representation of who you are as a trader, your risk appetite, your emotional tendencies, your patience level, and your ability to accept uncertainty without fear. When you build a system and choose to trade only according to that system, you eliminate the noise that destroys most traders. You stop jumping from idea to idea. You stop relying on hope during losing trades and overconfidence during winning ones. You shift from reacting to predicting, from chaos to clarity, from randomness to structure. The purpose of creating a system is not to control the market, because you never will, but to control yourself. The market offers endless possibilities, but your mind cannot handle endless choices. Too many options create hesitation, confusion, and emotional exhaustion. When you define the exact conditions you will trade, the exact risk you will take, and the exact behavior you expect from yourself, you remove the mental burden that cripples traders. Your system becomes the filter that separates opportunity from distraction. It becomes the voice that whispers this trade is yours or walk away. And when you learn to trust that voice, your trading transforms. But building a system is only half the journey. The real challenge and the real reward lies in keeping up the good work. Because consistency is not something you achieve once. It is something you maintain every day. Your system will only serve you if you honor it during winning streaks and losing streaks, during high volatility sessions and quiet markets, during confidence and doubt. Most traders fail not because their strategy is weak, but because their discipline collapses under pressure. They abandon their system the moment discomfort appears. They forget that the outcome of any single trade means nothing compared to the long-term edge of the system itself. When you commit to trading only on your system, you are making a deeper commitment to your own psychological growth. You agree to act with patience when your instincts crave action. You agree to stay objective when your emotions scream for control. You agree to trust rules instead of impulses. Over time, you become the kind of trader who is not moved by uncertainty, not shaken by randomness, and not destroyed by temporary losses. You become a trader who builds their success not on luck, not on shortcuts, but on structure, clarity, and disciplined execution. Building a trading system that reflects your personality and risk tolerance is the single most important foundational step in becoming a consistent and confident trader. Most traders enter the market searching for the perfect strategy, the magic indicator, or the secret pattern that will guarantee profits. But the truth that very few accept is that no system can work for you unless it aligns with who you are internally. Trading is not just technical, it is deeply psychological. The system you create is not only a set of rules for the market, it is a structured reflection of your strengths, weaknesses, emotional tendencies, and the level of risk your mind can comfortably endure without collapsing into fear or recklessness. When your system matches your internal makeup, you can follow it smoothly and consistently. When it doesn't, you will eventually abandon it, even if it is profitable for others. Every trader has a unique psychological blueprint. Some traders thrive in fast-moving markets where decisions must be made in seconds. Others need a slower environment where they have time to evaluate setups calmly and without pressure. Some traders can tolerate drawdowns and remain emotionally stable, while others panic at even small temporary losses. Some enjoy taking multiple trades per session, while others prefer one or two high-quality opportunities. These differences are not weaknesses, they are characteristics that shape the type of system that will work best for you. The mistake most traders make is trying to fit themselves into someone else's system instead of building one that fits their natural tendencies. When you force yourself into a strategy that conflicts with your personality, discipline becomes a constant struggle. But when your system is aligned with your psychology, discipline becomes natural because the rules feel comfortable and logical. Your risk tolerance is another critical component of system building. Risk tolerance is not what you say you can handle. It is what your emotions can handle in real time when money is actually at stake. Many traders claim they are comfortable risking a certain percentage of their account, but the moment the trade moves against them, their mind becomes overwhelmed. They begin to doubt, panic, or exit prematurely. A system built on Unrealistic risk assumptions will always collapse. To build an effective trading system, you must observe how your mind reacts during drawdowns, during rapid price movements, and during unexpected volatility. Your true risk tolerance can be discovered only through experience and self-awareness. Once you understand how much pressure your mind can sustain without becoming emotional, you can structure your position sizing, stop loss levels, and trade frequency in a way that keeps you centered and stable. A system that reflects your personality also respects your lifestyle. Trading must fit into your life, not disrupt it. If you try to trade a strategy that demands constant monitoring while you have responsibilities that pull your attention away, you will inevitably make mistakes, miss signals, or force trades out of frustration. Some traders have the time to trade intraday setups. Others do better with swing or position trading. A system that demands more time, focus, or energy than you can realistically offer will eventually break down. Your system should be designed to integrate with your daily routine so that trading becomes a sustainable practice rather than a source of stress or conflict. To build a system tailored to who you are, you must begin with honest self-observation. Pay attention to how you behave during different market environments. Notice whether you prefer clear mechanical entries or whether you feel comfortable with discretionary analysis. Notice whether rapid movements excite you or overwhelm you. Notice how you respond after wins and losses. Every reaction provides insight into who you are as a trader. Instead of judging yourself, study yourself. The market is a mirror that reflects your internal patterns. When you observe those patterns without resistance, you can shape a system that neutralizes your weaknesses and amplifies your strengths. Your system should also be grounded in rules that reduce uncertainty. Clear entry criteria, defined exit conditions, strict risk parameters, and structured trade management. Eliminate the need for emotional decision-making. But those rules must be rules you can follow naturally. If your system requires you to endure large stop losses, but you cannot sleep at night when the market is against you, the system will never work for you. If your system requires patience for days to wait for a signal, but you are naturally impulsive, you will sabotage your trades before they mature. Instead of trying to change your personality to match your system, reshape your system to complement your personality. You do not need to trade every style. You only need one approach that you can execute with calm confidence. Another essential part of building a system that fits you is understanding your emotional triggers. Every trader has emotional behaviors that surface under pressure. Fear of missing out, fear of losing, revenge trading, overconfidence, hesitation, and attachment to outcomes. A well-designed system protects you from these emotional tendencies. If you know you tend to overtrade when bored, your system may include a strict maximum number of trades per day. If you know you tend to hold losing trades too long, your system may require automated stops. If you know you panic during volatility, your system may avoid high-impact news periods. The system becomes a psychological safeguard, not just a method of trading. Your system should also reflect your tolerance for uncertainty. Trading is a game of probabilities, not certainties. Some traders are comfortable with lower win rates as long as the reward to risk ratio is high. Others need a higher win rate to maintain emotional balance. Neither approach is right or wrong. What matters is alignment. A trader who needs the reassurance of frequent wins will not survive a system built on rare but large payoff.
FS.
A trader who prefers fewer trades cannot sustain a high-frequency strategy. When your system aligns with your comfort zone, you reduce internal conflict, which strengthens your consistency. Market conditions also influence whether a system fits your personality. Some traders are naturally trend followers, comfortable entering when momentum is clear. Others excel in mean reversion environments where they can anticipate price returning to equilibrium. Your personality affects whether you prefer anticipation or confirmation, aggression or caution, early entries or late entries. Your system must match your natural way of interpreting movement. Once you understand your personality and risk tolerance, you can refine your system through backtesting and forward testing. These tests reveal not only the performance of the system, but also how you feel while using it. If you feel restless, stressed, or constantly tempted to override rules, the system may not align with you. A well-aligned system feels stable, logical, and emotionally manageable even during losing periods. A poorly aligned system feels like a constant internal battle. Building a trading system that reflects your personality and risk tolerance is an ongoing process. As you grow emotionally and psychologically, your system may evolve with you. Your experiences will reshape your understanding of your internal dynamics, and your system should adapt accordingly. You do not need to perfect yourself. You need to perfect the structure that supports you. When your trading system becomes a true extension of your inner world, you trade with clarity, confidence, and consistency because every decision feels natural and aligned with who you are. Trading only when your predefined conditions are met is the discipline that separates a structured trader from an emotional one. The market tempts you every second with movement, noise, and the illusion of opportunity, but without strict conditions, every movement seems like a potential trade. This is the trap that pulls most traders into chaos. A predefined condition is not simply an entry rule, it is a boundary that protects your mind from uncertainty and prevents you from acting impulsively. It tells you when to engage and, just as importantly, when to stay out. When you commit to trading only under those specific circumstances you have defined, you eliminate the randomness that destroys consistency. You stop chasing the market and begin allowing the market to come to you. The discipline to follow predefined conditions begins with accepting that the market offers infinite possibilities, but your mind can only function with clarity under limited controlled conditions. Every trader has experienced days where they enter trades that do not match their setup simply because the market looked like it was about to move. In those moments, the mind is not following structure, it is following impulses. A predefined condition acts as a shield against such emotional reactions. It forces you to approach trading as a process rather than an impulsive activity. When conditions are not met, you do nothing. When they are met, you act without hesitation. This binary clarity removes confusion and reduces emotional noise. Your predefined conditions should be precise, not vague. Vague rules create loopholes that the emotional mind exploits. A rule like enter when the market looks strong is an invitation for inconsistency. A precise condition defines exactly what strong means for you, whether it is a specific candlestick formation, a break of structure, a confluence zone, a trend confirmation, or a volatility signal. The market does not create uncertainty. Your undefined conditions do. The more precise your rules, the less space there is for hesitation or doubt. Precision in conditions is what allows traders to become mechanical in their execution, which is essential for long-term consistency. Another powerful benefit of trading only when conditions are met is that it filters out low-probability trades. Not every movement is worth trading, and not every signal carries the same weight. Many traders lose money not because they lack opportunities, but because they take too many opportunities that do not fit their system. When your conditions define your edge, they also protect your capital by preventing you from participating in market moments where you have no advantage. A good trader does not trade more. A good trader trades selectively. The market rewards clarity of selection, not frequency of action. Psychologically, sticking to predefined conditions strengthens self-control. Every time you refuse to take a trade that doesn't meet your criteria, you reinforce discipline. Every time you act only when your system allows, you strengthen your trust in the process. This trust becomes a stabilizing force during drawdowns. When you are selective and consistent, a losing streak does not shake your confidence because you know every trade was taken under valid conditions. But if your trades are a mix of disciplined and impulsive entries, every loss becomes a source of doubt, fear, and emotional instability. Trading only when conditions are met creates emotional insulation. One of the most challenging aspects of following predefined conditions is dealing with missed trades. There will be times when the market makes a beautiful move without giving your exact signal. These moments can trigger frustration, but they are part of the process. Your conditions are not designed to catch every move. They are designed to catch only the moves that align with your edge. Allowing a trade to pass because it did not meet your criteria is a sign of strength, not weakness. Over time, you realize that missing a move is far less damaging than taking a low-quality trade that leads to a loss. The discipline of waiting filters the market for you, leaving only the highest probability moments. Trading only when your conditions are met also creates consistency in data. If your entries are based on the same criteria every time, your data becomes reliable. You can evaluate your system objectively, identify patterns, refine your edge, and track performance with accuracy. But if your trading includes random or emotionally driven entries, your data becomes contaminated. You can no longer evaluate your system honestly because you are not trading your system. Consistent data comes from consistent decision-making, and consistent decision-making comes from following predefined conditions. This discipline also enhances patience. Patience is not the ability to wait endlessly. it is the ability to wait with purpose. When your conditions define the exact moment you should act, waiting becomes easier because you are not waiting for something vague, you are waiting for something specific. Your mind understands what must happen before you take action, which prevents the internal conflict that causes impulsive entries. Over time, patience becomes a natural part of your trading behavior because you begin to see the direct connection between waiting for your setup and achieving consistent results. Moreover, predefined conditions remove the burden of interpreting the market emotionally. When a condition is met, you execute without second guessing. When it is not met, you step aside without regret. This removes a tremendous amount of psychological pressure. You no longer ask yourself whether the trade feels right. You only ask whether it matches your predefined rules. This shift from feelings to structure transforms your mindset far reactive to strategic. Instead of trying to predict what the market will do, you simply wait for the market to reveal a situation that aligns with your edge. Your conditions should also include context. Many traders focus only on the entry signal without considering the broader environment, but your predefined conditions should integrate multiple layers: market structure, trend direction, volatility levels, support and resistance zones, and session timing. When your conditions incorporate context, your trades become more aligned with the overall market environment. This alignment increases probability and reduces the randomness of your decisions. Following predefined conditions also builds consistency in execution. Consistency is not something you force, it is something that emerges naturally from structured behavior. When you take every trade under the same criteria, your execution becomes predictable, steady, and emotion-free. You begin to act like a machine, not because you lack emotion, but because your rules protect you from acting on emotion. This consistency is what creates long-term profitability. It allows you to endure losing streaks without panic and enjoy winning streaks without overconfidence. Finally, the act of trading only when conditions are met creates a mental framework of neutrality. You stop taking losses personally because you know they are part of your system. You stop feeling overly proud of wins because you know they are the result of executing your rules. Your emotional connection to individual outcomes weakens, and your connection to the process strengthens. This mental neutrality is the psychological state from which true growth and mastery in trading emerge. Removing emotional decision-making by following structured rules is one of the most transformative shifts a trader can make because the majority of trading errors are not caused by lack of knowledge or weak strategies, but by the inability to manage emotions in real time. The market is a highly emotional environment, constantly triggering fear, greed, doubt, hesitation, and impatience. Without a structured set of rules to guide your actions, your mind becomes vulnerable to these emotional impulses, and your decisions drift away from clarity and logic. A rule-based framework acts as a psychological anchor, keeping you centered when your emotions try to pull you in unpredictable directions. It is not about removing emotions from trading, because that is impossible. It is about preventing emotions from deciding your actions. Rules create order inside an environment that is inherently chaotic. The market offers no guarantees, no fixed outcomes, and no certainty, and this lack of structure naturally creates anxiety for the human mind. In the absence of clear rules, your brain tries to create its own interpretations of what is happening, usually rooted in fear or greed. This is why traders often exit too early, enter too late, or hold losing trades longer than they should. They are not following a plan, they are following emotional impulses, responding to perceived threats or opportunities. Structured rules eliminate the need for internal negotiation. When you know exactly what qualifies as a valid trade, how much risk to take, and when to exit, you no longer need to debate with yourself during critical moments. The power of structured rules is that they shift decision-making from the emotional brain to the logical brain. The emotional brain operates in real time, reacting instantly to pressure, noise, and uncertainty. It wants immediate relief from discomfort. The logical brain, however, can only function when a clear plan exists. When your rules are defined before the trade, you allow the logical brain to take control. You're making decisions, from a place of clarity rather than reacting impulsively to whatever the market presents. This shift is what allows traders to remain consistent during volatility or drawdowns. When your actions follow structured rules, you reduce the psychological burden of trading. Emotional decision-making is exhausting because it forces you to constantly evaluate, decide, and reassess. Every movement in the market becomes a potential trigger for action. But with rules, the burden disappears. You no longer need to wonder whether you should enter, exit, wait, or hold. The rules decide for you. This reduces mental fatigue and increases the quality of your decisions. Over time, your confidence grows not because you win every trade, but because you trust the process guiding your actions. Rules also prevent destructive emotional behaviors from taking over. For example, revenge trading, a common emotional reaction, happens when a trader feels compelled to win back what they have lost. This urgency leads to rushed trades, oversized positions, and impulsive decisions. But when rules are in place, the structure protects you. You know your maximum number of trades, your maximum risk per position, and your criteria for re-entry. These predetermined boundaries act as guards that prevent you from slipping into emotional loops that can wipe out accounts. Likewise, overconfidence after a winning streak is another emotional danger. Success can distort perception, making traders believe they are seeing the market more clearly than they actually are. They begin to ignore risk rules, take larger positions, or trade in situations that do not match their system. Structured rules prevent this by ensuring that every trade, regardless of previous outcomes, must follow the same criteria. The rules do not change just because you are winning. This consistency keeps you grounded and prevents emotional highs leading to reckless decisions. One of the most important aspects of rule-based trading is that it eliminates the emotional need to predict. When traders rely on feelings to anticipate the market, they become emotionally attached to outcomes. They want the market to move in a certain direction, and this desire creates tension. But when you follow rules, you are no longer trying to force a prediction. You are simply waiting for your edge to appear. This detachment reduces anxiety and allows you to observe the market objectively. When you stop predicting and start responding according to rules, your emotional involvement decreases dramatically. Another essential benefit of structured rules is that they create emotional consistency. Without rules, your decisions will reflect your emotional state. Calm one day, stress the next, impatient another. This inconsistency leads to erratic performance, but rules standardize your behavior so that your decisions remain stable even when your internal state fluctuates. The market may be unpredictable, but you are not. This psychological stability is the foundation of professional trading. Structured rules also help you navigate uncertainty without fear. Uncertainty is the core of trading, and the mind instinctively dislikes it. It tries to reduce uncertainty through emotional behaviors, often leading to poor decisions. Rules act as a map through uncertainty. They guide you even when the path ahead is not clear. When you follow rules, uncertainty becomes easier to accept because you are not searching for perfect information. You're simply waiting for conditions that validate your edge. Moreover, rules allow you to evaluate your performance honestly. When you follow a structured method, your results become meaningful data. You can identify which parts of your system work and which need improvement. But if your decisions are emotional, your performance becomes impossible to analyze because your behavior is inconsistent. Structured rules give you clarity, allowing you to refine your strategies and grow as a trader. Rules also remove emotional attachment to individual trades. When you follow a system, each trade is just one event in a series, not a personal test of your skill or worth. You stop judging yourself based on whether a single trade wins or loses. This neutrality is crucial because emotional attachment to outcomes increases fear, hesitation, and self-doubt. When your identity is not tied to the outcome, you execute more fluidly and objectively. Structured rules increase trust in the process. Emotional trading happens when a trader lacks trust. They don't trust the market, their strategy, or themselves, but when rules have been tested, refined, and proven, they become a source of confidence. You no longer rely on hope or intuition. You rely on a structured, intentional approach that has a definable edge. This trust reduces emotional noise and allows you to remain disciplined even under pressure. Following structured rules also helps you recover from losses more effectively. Emotional traders spiral after losses because they try to correct mistakes emotionally. But rule-based traders understand losses as statistical outcomes. They stick to the system, knowing the edge will play out over time. By following rules, you prevent one loss from triggering a chain of emotional decisions that amplify damage. Finally, structured rules create freedom within the market. Paradoxically, the more rules you have, the more psychological freedom you experience. You are not trapped in emotional reactions. You are not overwhelmed by choices. You are not confused by conflicting signals. The structure liberates your mind so you can focus on execution rather than emotion. This freedom is what allows trader to evolve from chaotic decision makers into confident, consistent performers. Focusing on long-term consistency over short-term outcomes is one of the most important mindset shifts a trader must embrace, because the market is designed to test your patience, your emotional resilience, and your ability to think beyond the immediate moment. Most traders approach the market with the intention to win today, to make money this week, or to catch a big move right now. This short-term focus creates emotional volatility, forcing traders into impulsive actions, overtrading and abandoning their systems whenever the results do not match their immediate expectations. But true growth in trading only begins when you detach your identity from individual trades and commit your energy to the long-term process. Consistency is built not through one perfect trade, but through thousands of disciplined, structured, controlled actions carried out over time. When you focus on long-term consistency, you begin to understand that every trade is just one small piece of a much larger picture. No single trade defines your success, your skill, or your future. The market is a probabilistic environment, and each trade is simply one event within a series. Some trades will win, some will lose, and some will break even, but none of them can determine your overall growth unless you allow them to. Short-term thinking forces traders to react emotionally to every fluctuation. A small loss feels like failure. A small win feels like proof of mastery. This emotional roller coaster becomes a trap that prevents objective decision-making. But when you step back and look at your trading through the lens of long-term performance, you no longer feel pressured to make every trade perfect. You shift your focus from outcome to execution, knowing that your edge can only emerge over time. Consistency requires a deep acceptance of probabilities. Even the best systems will have periods of drawdown, losing streaks, and phases where results seem random. The trader who thinks short-term will panic during these moments and begin searching for a new strategy, changing rules, or forcing trades to speed up recovery. In doing so, they break the consistency required to allow their edge to manifest. The long-term thinker understands that drawdowns are not signals of failure, but natural elements of the game. They continue to follow their system with patience and discipline, knowing that the edge has not disappeared simply because the recent outcomes were unfavorable. This ability to sit through uncertainty without altering the system is what separates the consistent trader from the emotional trader. Focusing on long-term consistency also trains your mind to detach from emotional reactions. The trader who thinks short-term feels every loss intensely, as if it threatens their identity. They begin to fear losing, which leads to hesitation, premature exits, or avoiding valid setups altogether. Or they become overly confident after a winning trade and increase their risk impulsively. This emotional cycle destroys stability. But when your focus is on the long term, each trade loses its emotional weight. Wins are not reasons to celebrate excessively, and losses are not reasons to feel defeated. Every result becomes just data, neutral, informative, and part of the journey. This emotional neutrality allows you to operate with clarity and consistency regardless of the immediate outcome. Another powerful aspect of long-term thinking is that it shifts your attention toward process rather than reward. When you become committed to consistency, your daily focus moves toward following your rules, executing your setups properly, managing risk according to plan, and maintaining discipline. You begin to judge your success not by whether your trade made money, but by whether you followed your system correctly. This shift is transformative, because process-driven trading naturally leads to correct outcomes over time. Reward-driven trading, however, leads to shortcuts, impulses, and emotional decisions that destroy long-term growth. When you measure success by process, consistency becomes your identity rather than something you chase. Long-term consistency also helps you manage risk more effectively. A trader chasing short-term rewards often takes excessive risk to accelerate results. They increase lot size impulsively, ignore stop losses, or enter trades that do not align with their rules. This behavior may lead to temporary wins, but eventually it results in catastrophic losses. The trader who values long-term consistency understands that risk must be controlled on every single trade. They never risk more than their plan allows, because they know that survival is the most important principle in trading. You cannot achieve long-term consistency if you put yourself in situations that threaten your ability to continue trading. The consistent trader prioritizes preservation over rapid gains because they understand that longevity is a form of power in the markets. A long-term focus also prevents the emotional trap of short-term comparison. Traders often compare their daily or weekly performance with others, leading to feelings of pressure, inadequacy, or competition. But trading is not a race. It is a personal journey defined by your own system, your own risk tolerance, and your own psychological landscape. When you commit to long-term consistency, you stop comparing yourself to others and begin comparing yourself only to your past performance. You focus on gradual improvement, stable execution, and personal growth. This internal focus strengthens your confidence and prevents external noise from influencing your decisions. Long-term consistency also reveals patterns in your behavior that short-term thinking hides. When you evaluate your performance over months or years, you begin to see recurring habits, mistakes, strengths, and weaknesses. You identify which setups work best for you, which market conditions suit your system, and what psychological triggers affect your execution. You can refine your system with accuracy because your data is based on consistent behavior rather than emotional randomness. Without long-term consistency, improvement becomes impossible because the data is too chaotic to analyze. Growth requires stability, and stability comes from focusing on the long-term process, not on the outcome of the moment. Thinking long-term also allows you to embrace slow, steady growth. Many traders quit because they expect immediate results. They want to double their account quickly, catch huge moves regularly, or achieve mastery without enduring discomfort. But the market rewards patience and punishes urgency. Consistency is built through small, repeated actions, proper entries, managed risk, disciplined exits, and emotional control. Over time, these small actions compound into transformative growth. When you understand this, you no longer feel desperate for quick profits. You value progress rather than speed. Focusing on long-term consistency also strengthens your psychological resilience. Trading becomes less stressful because you no longer attach meaning to every trade. You no longer fear losing because you know losses are part of the game. You no longer fear drawdowns because you understand they are temporary. You no longer feel pressured to perform on command because your identity is not tied to immediate results. This emotional freedom allows you to think clearly, act decisively, and execute your system with stable confidence. Finally, the commitment to long-term consistency becomes the foundation upon which all other trading skills are built. Discipline, patience, risk control, psychological stability, and mastery of execution all stem from the decision to prioritize the process over the outcome. When you view trading through a long-term lens, the noise fades, the emotional turbulence slows, and the path becomes clear. Consistency emerges not from force, but from alignment between your mindset and your method. Maintaining discipline to execute the system through all market conditions is one of the most demanding psychological challenges a trader faces, because discipline is not a switch you turn on when it feels convenient. It is a continuous commitment that must be upheld even when your emotions, the market, and external pressures push you in the opposite direction. A trading system becomes powerful only when it is executed consistently, and that consistency is born from discipline. Without discipline, even the most refined system becomes meaningless. Traders often build excellent strategies, meticulously crafted rules, and detailed plans, yet they still struggle because they lack the discipline to follow what they created. Execution is the bridge between knowledge and results, and discipline is the foundation of that execution. The true test of discipline appears when the market becomes unpredictable. During ideal conditions, clean trends, smooth price action, straightforward setups, discipline feels easy because following the system aligns naturally with the environment. But markets are not always kind or clear. They shift into choppy sequences, unpredictable volatility, confusing patterns, and long periods of consolidation. These phases challenge the trader's emotional stability and tempt them to abandon their system. In such moments, discipline is not just a trading skill. It becomes a psychological anchor. It reminds you that your system was built to withstand different environments, not just favorable ones. When you maintain discipline during difficult conditions, you protect your long-term edge rather than sacrificing it to emotional impulses. A disciplined trader understands that every rule in their system exists for a reason. Stop loss levels, entry criteria, risk limits, and position sizing guidelines are not suggestions. They are safeguards designed to protect the trader from themselves. The human mind is prone to impulsivity, especially when confronted with uncertainty. Without discipline, you may convince yourself that bending a rule just this once is harmless, but every exception weakens your structure. A single undisciplined decision can open the door for a cascade of emotional choices that lead to overtrading, revenge trading, and uncontrolled losses. Discipline is the force that prevents exceptions from becoming habits. One of the psychological barriers to discipline is the illusion of control. Traders often believe they can outthink or outsmart the market when a situation looks promising. They justify violating their rules because they feel they understand what the market is about to do. This illusion is dangerous because it disconnects the trader from their system and reconnects them to emotional decision making. Discipline means acknowledging that you cannot control the market, and the only thing you can control is your behavior. Your system is the structure through which you express that control. Every deviation from the system reflects a moment where emotion overrides logic. Maintaining discipline also requires emotional endurance. Losses, missed opportunities, and slow market phases trigger frustration, impatience, and doubt. These emotions tempt traders to abandon their system and chase immediate results. But discipline teaches you that immediate results are irrelevant. The only thing that matters is executing the system that has proven itself over time. Discipline allows you to sit through temporary discomfort without resorting to impulsive actions. It helps you accept that not every day, week, or even month will be perfectly aligned with your goals. The market does not reward impatience. It rewards consistency rooted in discipline. Another crucial aspect of disciplined execution is the ability to handle drawdowns. Drawdowns challenge your confidence and your belief in your system. When you experience consecutive losses, the mind becomes vulnerable, questioning whether the system is still valid or whether you should change the approach. Indiscipline thrives in these moments because changing or abandoning the system feels like a solution to discomfort. But a disciplined trader recognizes that drawdowns are a statistical inevitability. They do not signal failure, they signal variance. During drawdowns, discipline becomes the force that keeps you aligned with your long-term edge. It prevents emotional modifications to your system and protects you from sabotaging your own progress. Maintaining discipline also helps prevent overconfidence during winning streaks. Success can be just as dangerous as failure if it leads to complacency. Traders who experience a series of wins often loosen their rules, increase risk without justification, or begin taking trades that fall outside the system because they believe they cannot be wrong. This is the moment where discipline is equally necessary. Your system does not change just because you are winning. A disciplined trader remains grounded, executing the same way after a win as after a loss. The system dictates the behavior, not the outcome of the previous trade. Discipline is also closely linked to patience. The market does not always provide opportunities, and a trader without discipline will feel pressured to create opportunities that do not exist. They begin to force trades, reduce their standards for setups, or enter prematurely because waiting feels uncomfortable. Maintaining discipline means accepting that sometimes the best trade is no trade. It means trusting that your edge will appear and your job is simply to be ready, not to fabricate entries out of boredom or fear of missing out. When you wait for your system's valid signals, you reinforce discipline with every decision. A disciplined approach also strengthens your relationship with risk. Every system includes risk management rules, but many traders break them when emotions intensify. They widen stop losses, move stops farther away from the entry, add to losing positions, or increase size impulsively. Indiscipline around risk is the fastest path to destruction. A disciplined trader respects risk limits absolutely. They understand that risk rules are not constraints, they are pillars of survival. Discipline transforms risk management from a burden into a natural part of execution. Another dimension of maintaining discipline is self-awareness. Discipline does not come from force. It comes from understanding your psychological tendencies. By observing your emotional patterns, what triggers impatience, what causes hesitation, what sparks greed, you become better at anticipating moments where discipline may falter. This awareness allows you to strengthen your structure proactively, adjusting your environment, routines, or habits to support disciplined execution. A trader who understands their emotional tendencies is far more capable of maintaining discipline than one who ignores them. Discipline also requires a commitment to continuous learning. The market evolves, and while your system may remain stable, your understanding of yourself and your reactions must deepen over time. Maintaining discipline in all conditions means regularly reviewing your trades, journaling your decisions, and analyzing whether you followed your rules. This reflective practice reinforces discipline by creating accountability. When you clearly see how disciplined or undisciplined you were, you gain the power to improve. Environmental control is another element of discipline that traders often overlook. Your surroundings and routine play a role in your ability to stay disciplined. A chaotic environment produces chaotic decisions. Maintaining discipline means creating a trading environment that supports focus, organized workspace, proper time for analysis, minimize distractions, and a structured routine. When your environment aligns with your intentions, discipline becomes easier to maintain. Maintaining discipline also demands humility. You must accept that the market does not owe you anything and that your system is not a guarantee but a guide. Humility protects you from the arrogance that leads to undisciplined behavior. It reminds you that your success comes from following the rules, not from believing you can predict or control outcomes. Humility keeps you aligned with the reality that discipline is a continuous effort rather than a one-time achievement. Ultimately, discipline is not built through motivation but through repetition. Every time you follow your system despite temptation, you strengthen your discipline. Every time you avoid an impulsive action, you reinforce your structure. Every time you choose patience over urgency, you deepen your consistency. Discipline becomes a habit, formed through countless small decisions made with intention and clarity.